Hey, this is Alex with your real estate market update for Placer, Sacramento, El Dorado County. Let's jump in and take a look at some numbers. As you can see, our numbers are up until May. This is a 2-year look back, and we're seeing the same market trends that we've talked about really since January, where we have increased pending activity. Inventory is still pretty low, but it is recovering. We look at price per square foot, and it's still trending upwards. I suspect that when June comes in, we'll see that increase as well. Days on market trending downward, and our pendings are kind of slightly trending upward, which makes sense. Here's an interesting graph. We look at for sale versus sold, and we see the gap widening quite a bit. So when the June numbers come in, it'll be very interesting to see how that affects our market. And then finally, months of inventory. Even though we have that gap increasing, months of inventory as of into May was still trending downward. But really what I want to talk about today is this website I put together that tracks foreclosures. So this tracks them in real time. It takes the listing data from MLS, pulls them over into here, and shows us what the foreclosure activity looks like in our region. And you see right now we have 26 foreclosures. This is a low number. I've seen this as high as 35 to 40. It's interesting to me. So I went in and I took a look at our market. So this is a map view of our market. You can see you got Folsom, Auburn, Sacramento. And let's take a look at our distressed real estate. And I'm going to make a point with this. You look at 30 days, 60, 90, 6 months. So in the last 6 months, these are the notice of defaults, people that haven't been able to make their mortgage payment in our region. Everything there with a yellow exclamation mark is a defaulted property. And then we can add into this the trust deed auctions. Why aren't we seeing these properties hit the market? Why aren't we seeing more short sales hit the market? Because right now we have 26, but I would say there should be a lot more. I think I know why, and it is the crisis of cheap interest rates that is causing this. And this is a property in Rockland. I've blocked out all of the client information, owner information, but as you can see, 3,600 square foot home, 9,000 square foot lot, built in 01, and it recently sold in December of 21 for $1,324,000. Let's go in and look at the mortgage data on this. And this tells a really interesting story. So they put down roughly $300,000 to buy this home, and they have a 30-year fixed. It's a jumbo loan. So I would say the rate on it is probably about 3%. This same person today, if they went to buy this house today at 6.5%, they wouldn't qualify for this loan. When this property sold in September of 21, the loan amount was $377 and some change. This person refinanced at $372, probably get a lower rate, 4.25. In 2021, there was another refinance of $250, and then it sold. It was a resale at $559. Then there was a second mortgage. I'm guessing it was the second. And then you had a consolidation, and now it's sold again. So I point this out to you because when I was doing loans, I was a mortgage guy up until 2009. I had a number of clients that came to me 6 to 9 months at a time, and they would refinance their house and use that as a third source of income. They'd run up their credit cards, they'd come to me, get an equity line, consolidate them in the equity line, and then get a new first mortgage, and they were stacking debt and stacking debt. Today, you don't have that option. You don't have it. And let's go back to our map. That's what's going on right here. If you're in trouble right now and you got credit cards that have accumulated, you got some major life event where you need some cash, you're having to spend your cash reserve because you can't go out and get cheap money anymore. 85% of all homes in the United States are financed at a sub 3% mortgage rate. So if you get in trouble on a sub 3% rate, and now you go to refinance at a 6.5%, 7% rate, you're not going to qualify. And that's what's going on right here. We got drunk on cheap interest rates. The Wall Street guys went in and got us all to buy into these cheap interest rates, and our payments were affordable. Well, now affordability's left the market, and people are trapped in their homes. And that's what I see right here. What's happening in the commercial market is relevant to this story, and this Bloomberg article points it out. We have major Wall Street investors that are walking away from commercial properties. You can see right here, world's empty office buildings have become a debt time bomb. You see, debt time bomb has been talked about quite a bit in the last 30 days. When they did the debt ceiling, they ignored the U.S. debt time bomb. And that debt time bomb is dealing with the banks, how the banks have these securities that they bought, which is the U.S. debt, at 3%. Well, now you can buy those same securities at 7%. So your 3% security is effectively worth half. And this is what's causing the regional banks to run into trouble. And we've had a couple of big banks that have failed recently. I read the other day that Bank of America has $100 billion in U.S. securities that are now worth half of that because interest rates have gone up. So we have a real problem. I don't know where it's going to lead, but if what's happening in the commercial market starts to trickle over into the residential market, I think that there's going to be some real trouble to be had. And when you look at this map, you got to scratch your head and think, where is this market heading? So I don't have a crystal ball. I don't mean to be an alarmist, but that's my market update. So if you like this information and want more of it, follow me, give me a thumbs up, share this with your friends, and I'll catch you on the next video. Thanks.